ESG investing. What does that even mean? What does ESG mean? Is it something for me? Well, if you ask me, it makes sense that if a company is sustainable and has good governance and respects the environment, they should be a great long-term investment. Well, in today's video, I go over what ESG means, how you can choose ESG funds, ETFs in that matter, and how it is very different and how you might be able to get a better result from long-term investments if you use the ESG mentality. Now, stay tuned because in today's video, I'll go over 7 ETFs that may be in your best interest if you're looking for something to get your foot in the door of ESG investing. So a little while ago, I put out a video and asked my friends and family what kind of advice or what kind of topics they'd like me to cover. And my mom actually said that she wanted to know if there is any way to invest in quote unquote good companies. And then it got me thinking. There's the ESG investing theme. It's a kind of a model on how certain managers and certain funds kind of put together a portfolio. They use ESG themes. Basically, it's environmental, socially responsible, and governance. And those 3 categories break down a little further, but the ESG mutual funds ETF themes kind of fit into that theme. Those 3 kinds of rules, I guess you could say, for how they pick the companies that they put your money to work in. Now, of course, my mom is primarily a retirement investor. She doesn't really go and do trades and put in options contracts and all that stuff, so she has a basic account. So unfortunately, since about November in 2020, they actually started pushing out these social responsible funds out of retirement plans, and you can go check my video on that where I talk about how the social responsible funds are not really for 401k or 403b programs. So with that being said, this newer investment theme is sort of being pushed out of the vast majority of what individual investors like you and I really have access to, really can learn about. So let's change that. Now, unlike most of my videos where I dive deep into the numbers, today's video is going to be a little bit less of that and a little bit more about education around the environmental, social, and governance funds. And I want to give you guys some options to invest in while you guys have or are thinking about using this theme to govern your investing strategy. All right, first let's go into the E of ESG, and that E stands for environmental, and they break down the qualifications or quantifications on how they evaluate the environmental portion as follows. The criteria may include a company's energy use, waste pollution, natural resource conservation, and treatment of animals. The criteria can also be used in evaluating any environmental risk a company might face and how the company is managing those risks. For example, there are issues related to its ownership of contaminated land, its disposal of hazardous waste, its management of toxic emissions, or its compliance with government environmental regulations. So again, environmental is pretty much what their impact is. In the environment, there's like those clean energy companies, green energy companies, very minimal environmental impact companies. Those are all classified under the environmental portion. Now let's take a look at the S, and that S is for socially responsible. And the criteria for this is as follows. It's a look at the company's business relationship. Does it work with suppliers who have the same value? Does the company donate a percentage of its profits to the local community or to encourage the company or the employees to do the same? Do the company's health conditions, workplace conditions, are they good for the employees? And do they also take into consideration other stakeholder needs as well whenever they do anything? This would be kind of like how if we're going to put a factory in a new community, how does that community react to this new factory being there? Will it hurt their, potential valuations of their home? Will it hurt maybe their infrastructure? Will it instead provide jobs, provide opportunity for people in the community to then prosper? Those are the kinds of things that the socially responsible portion of the S in ESG stands for. And lastly, let's go to the G, and that's governance. This one's kind of a little bit more confusing, but let's dive into the definition. For governance, investors may want to know that the company uses accurate and transparent accounting method, and that stockholders are given an opportunity to vote on important issues. They may also want to have assurances that companies avoid conflicts of interest in their choice of board members, don't use political contributions to obtain unduly favorable treatment, and of course, don't engage in illegal practices. So this governance portion is more in regards to like accounting transparency. In the news right now, there's a lot going on in China about how their accounting practices aren't very transparent, and it's kind of accepted that for those people who invest in Chinese companies, they're kind of a gray black book accounting anyway, so that's the norm. The governance section would eliminate all those companies that don't have a third-party audit happening at all times with transparent results. Also, they want to make sure that the board of directors don't have any conflict of interest to, propel potentially through, favors or illegal or backdoor transactions to get an upper hand in their respected industry. Now, an important thing to remember when looking at ESG funds or ETFs is that many times these companies may not meet all of the ESG criteria. They might have really good governance, really good social impact, but their primary product may not be environmentally friendly. They may have a lot of waste due to their production of, let's say, plastics or other types of products, but they meet the other two, or they meet one of the main criteria, which can be very, very confusing when looking at different funds. Now, we'll go into 7 funds that I believe will be pretty acceptable for someone who's looking into starting investing in ESG funds. But for now, just understand that the ESG marketplace for ETFs and mutual funds is not that transparent as far as like, okay, because they're in this ESG fund, they must be an angel company that doesn't do anything bad. Their CEO is awesome. It's not that. It's just that they meet at least 1 to 2 of these criteria and they're placed in there. So what are the pros and cons of investing in an ESG fund? In the end, we want to make some money, right? We want to have our money do something impactful, but we also, at the end of the day, are investors. We're investing in companies that we feel are going to do better and perform better than its peers potentially. So what are the pros in investing in companies like this? Well, one good thing is that these companies are now becoming a lot more, I guess you could say, popular. So people are now thinking about impact investing, socially responsible investing, right? Clean energy investing, going green. These are now becoming very trendy and becoming very attractive to investors. Another pro with these companies is that they're sustainable. Now that might be obvious, but you can tell environmentally sustainable, socially responsible, that's all sustainable. And governance means that you are in line with the legal practices of your industry and you don't do anything backdoor. Those are all very sustainable practices which all good companies should adhere to. What you would think. So let's flip that over and look at the cons. Well, the cons are that a lot of the companies are excluded because maybe they cannot, based on their product or based on their location, meet some of these criteria. Not that they're bad companies or evil companies, it's just that they are unable to do it because of the industry they're in or potentially because of the financial situation that they are in. All right, so now we know what ESG stands for. We kind of know what the pros and cons of investing in ESG funds are. Let's break down the 7 ESG funds that may be a good option for you to invest in. All right, so our first ticker today is going to be ticker DSI. It's the Ishares Msci KLD 400 Social ETF. Now this ETF has an expense ratio of about 0.25%, and it has a net asset amount of 2.63 billion with the B dollars. It has done quite well over the past 1 year. As you can see, it's a trend due to its heavy tilt toward technology. If we look at some of the holdings in this DSI ETF, you can see it has a lot of investments in the communication and technologies, which had a great year. As you can see here, Microsoft, Facebook, Google, Tesla, Visa, a lot of companies that have had a very good 2020. Now, this company does have a very strong tilt towards technology, healthcare, and it might suit investors who are interested in taking part of that side of the market, as well as investing in more socially responsible stocks. Next, a very big company, as we know, Vanguard. This is their ESG ETF. They have the lowest expense ratio of all the ETFs I'm going to go over today at 0.12%. Their net assets is 2.98 billion. Now, when I initially made this video, when I recorded the first part of the video, the net assets were below 2.5 billion. So this fund has had a ton of inflows over the past 6 months, I'd say. And we can go ahead and look at the holdings to see what exactly people are investing in through this fund. And very similarly to the first fund, most of their holdings is going to be in technology, communication services, healthcare, financial and consumer cyclicals. The top holding here is Apple. Apple didn't appear in the DSI, but it is in this Vanguard ETF. Now, the top holdings only encompass 26% of all the assets, and the entire holdings or basket of stocks this ETF invests in is over 1,500 names. So you could be seeing a lot of different names with very, very small positions in this ETF. The next one is going to be another one by Ishares, ticker symbol ESGD. It's the Ishares ESG Aware Msci EAFE ETF. This one has an expense ratio of 20 basis points or 0.2%. And it has the top holdings in a very similar but very similar fashion as far as what they invest in. But this ETF is actually ex-Canada and ex-US. So all of these companies here are not in the United States or Canada. So we see different names here like Nestle, Novartis, Toyota, and a lot of them have very different ticker symbols as they are listed on different exchanges. So if you're an investor who wants to broaden their portfolio holdings by geographic changes, you can go ahead and invest in this portfolio to get exposure to foreign companies. Now, one thing to mention is that the European and even the Japanese have a little more progressive environment in their ESG kind of regulation. So these companies are, comparatively to US and Canada, potentially have more strict rules on how the company is managed, governed, with social and corporate governance issues. Next, we have our first one by Spider. This is the Ssga Gender Diversity Index, ETF SHE. Now, this portfolio debuted in 2016, so it has a much smaller net asset amount, and its strategy is a little bit different based on or based off of what we've seen in the last three funds. This fund is a gender diversity fund, which seeks to find companies that have better than average female representation on their executive committees compared to their peers. Now, this doesn't mean a 50-50 balance. What it means is that compared to its peers, for example, PFau, which is its largest holding, has 4 out of 11 females in their leadership team. But this is a better than average in relation to their peers, so they make the cut for this fund. This fund has another 20% basis point expense ratio, and the top holdings again is going to be PFau, Texas Instruments, Walt Disney Company, and Visa. So a lot of repeat names here, even though it is a completely different fund strategy. We see Visa and Walt Disney again, as well as Square. And this this ETF, very similar holdings, strong technology, strong healthcare, communication, financial, and consumer cyclical. So a lot of these funds do have the same kind of sector allocation, and that's, I want to say it's almost because these types of industries have the opportunity to be ESG positive in the environment we have today. But this is SHE from Spider. Next, we have ticker symbol TAN, Invesco Solar ETF. Now, this is a large ETF. It's been around for probably the longest here on this list. It has 3.63 billion in net assets, and it's done quite well. And the reason why it's done quite well is because the solar has been taking off. A lot of, progressive clean energy stocks have been outperforming the market really well. It's probably the only portion of the energy sector that has done anything, before the recent run on the oil prices due to OPEC's announcement about their halting of oil production. This one has one of the higher expense ratios at 0.69%, 69 basis points, and it has a much smaller holding. Now, their diversity obviously is going to be smaller, most of it in utilities and technology, and the top 10 holdings is 60% of their total assets. Now, this portfolio only has about 28 stocks, so it's a much more volatile, much more specialized portfolio. Now, one thing to remember though is that you still are gaining exposure to solar. You might want to consider potentially using this as a smaller position on the overall ESG portion on your portfolio with a bias towards solar. Again, this has a multitude of investments and will allow you to buy stocks that are not necessarily available through the common exchanges. As you can see here, any of these with the dots, they're listed on non-US exchange. Next on our list, we have SPYX. This is the Spider S&P 500 fossil fuel reserves free ETF. So this basically is the S&P X. Any companies that are reliant on oil or gas or fossil fuels, so things like ExxonMobil are taken out. Now keep in mind this ETF does have 460 names. So out of the S&P 500, that means only about 55 companies are excluded. So this is going to perform very similarly to the S&P 500. As you can see, the holdings pretty much mirror the S&P 500 as far as their equal or weighted composition of the index. And lastly, we have the Ishares Msci USA Select ETF. Now, this social responsible ETF is a fast-growing, so it's still small, $2.3 billion in assets, and it has a select strategy from the iShares ETF manufacturer, and the select strategy only has 145 holdings in the portfolio. So this is not simply like the old fund where we had X oil and gas companies. This company, or this ETF, subtracts big oil, big tobacco, and companies that take the ESG movement or theme very seriously. For example, Home Depot and consulting firm Accenture ACN has much more progressive ideas on how they should tackle ESG or socially responsible governance on their company. Now, as we push over to the holdings, again, the top 10 holdings encompass about 25% of total assets, which isn't that much, but it does invest in many of the same names that all the other companies or all the other ETFs do. So again, I don't suggest buying all 7 of these. Take a look at the top 10 holdings or the entire portfolio of holdings to see whether or not you agree with the way that these ETFs invest in and how you are going to kind of manage the risk on this side, as again, your sector diversification will be very heavily impacted by means of having a very large technology, communication, healthcare, financial service, and consumer cyclical weight. Now, as I mentioned earlier in the video, 401k plans and 403b plans, due to the current legislation that was approved in November, are going to slowly kick these funds out because of something called the PFau guideline, where basically if there's no metric or quantitative analysis that shows that these funds, these socially responsible themed funds, provide you with good or above average return, they have no place in a retirement portfolio, which I tend to agree with. But you got to kind of understand that, hey, you know, these are these people. I mean, this is their money. It's not your money. So while you have to do what's in the best interest of them, some people like myself want to invest in companies that we believe in. So there's this and that. I have a video where I go over the docket. It's about 85 pages that talks about what this rule encompassed and why it passed ultimately. But until then, we'll see you in the next video. There's a solar one where the trends of the industry fell down. Well, he's back.